Sagar, good to see you, man. Like,
Yeah, good to see you, man.
yeah,
I know our journey started 2011, 10 maybe, back in Hilton.
2010.
Yeah.
Yeah,
Yeah.
you had just gotten out of school with your undergrad,
Yep.
and I had just
Yep.
finished my
Exactly.
MBA, and like we both joined what was called Revenue Management Development Program to jump right in to figure out how to do revenue management for Hilton hotels.
Yeah, it was a weird path for me because I was pre-med in college, and so I thought I was going to be a doctor. And I think not my wife's neighbor worked at Hilton,
Mm,
and she gave my resume to her neighbor who worked at Hilton, and they got in the hands of the RMCC, the Revenue Management Center for Hilton, and applied for the program. And then, yeah, we started there and jumped right in, even though we'll get to this. My background's in hotels as a family. My parents started in the business about 35 years ago. And I quite frankly didn't want anything to do with it when I was in college and somehow found my way back to it, albeit
yeah.
not in the business directly, but through Hilton back in 2010.
What was going through your mind, like pre-med and then deciding, okay, I'm going to go into the hotel space? What led to that shift for you?
Yeah, I think quite honestly, I think I didn't really take recruitment very seriously in undergrad because I thought I was going to be going to medical school. And so I didn't really go after a lot of the traditional internships,
Mhm.
consulting, investment banking, or other corporate finance. And I was just at a point where I needed to get some experience.
Yeah.
And obviously grew up in the hotel business, saw it firsthand with both living in properties with my parents, running them. And then as my dad and mom grew the business with their partners, it was obviously something that was something that I was familiar with. And my perspective was that I didn't want to be in the business via the family. I wanted to do something on my own and get some experience. And just happened to be that there was a connection to Hilton, not even through my family. It was through, through my wife's family and
Yeah.
applied. And I honestly just took a leap of faith. It wasn't it wasn't like I want to get in the hotel business and I want to
Mhm.
get experience outside the family. It wasn't, I didn't even know that I was going to join the family business later on, to be honest. It
Right.
was really just, it was a good opportunity. I thought the development program seemed really interesting. At that point, revenue management was still new in terms of being more formalized in the
Mhm.
industry. I think it's always been around, but I think Hilton was one of the first to really create a really big center around it to help support their hotels that didn't
Mhm.
have a dedicated revenue manager within the hotel team.
Yeah.
And so I was pretty excited about the opportunity to be part of something that was more cutting edge, I would say, in the industry. And so, yeah, it really wasn't anything that was like
Yeah, it
methodical.
wasn't
It
part
was
of a master plan. It was like you're like yeah, it just seemed like an interesting opportunity, but not even thinking about the family business yet at that point.
Yeah. And
Yeah.
honestly, I learned a lot that I wouldn't have learned through
Mhm.
the family business because of the focus, the approach, the process that probably was still new to even my family business in terms of running hotels. Again, revenue
Mhm.
management for a lot of owner operators back then was the revenue will come, right? We'll figure it out. It
Yeah.
wasn't as methodical as we think about it today. And I'm sure we'll
Mhm.
get into that, but it was definitely new to a lot of owner operators. And that's why I think the brand started these centers and these services to be able to support owners like that, to be able to make sure they were efficient and optimal with whatever they were doing from a pricing standpoint.
Yeah. Yeah. And while I stuck around for a while, like you went off to then go do your MBA after being there for a few years and then went into consulting space. Like
Yep.
it seemed like still path was not like, "Oh, I'm gonna go run my family business." Right?
Yeah, no, you're completely right. I think I've reached a point where I was like, I want to get my MBA and get another shot at business school because while my undergrad was in business, I was preoccupied of becoming a doctor, so I didn't really take the recruitment seriously. So the MBA was
Mhm.
a second chance more for me to be able
Yeah.
to do that and recruit and really find out what I wanted to get experience with. And so I ended up joining Ernst& Young in their consulting practice.
Mm.
And it was a tremendous experience. I think more than the content of what I was working on, just the process of being able to break down problems, think through things that are new to me, like a new business on a new project, new challenge. While there are commonalities between the companies in terms of what you're trying to use to solve those problems, like each
Yeah.
company was different that I worked on. And
Yeah.
I really learned how to think and create presentations and really document what we were trying to convey to a client or to another
Mhm.
party. And so it was a fascinating experience. And honestly, I don't know if I would have stuck around consulting for a long time just because of the travel. But when I started, I had no intention still of coming back to the business. It was not like, hey, let me get some experience outside of even the industry and
Yeah.
come back. So it was one of those things. But then I ultimately joined back in 2016. And the reason for that was because my family business was merging or in talks to merge the operations with my best friend's family business. And so it was
Uh-huh.
a situation where second generation was coming together.
Yeah.
And I thought that was really exciting because I would be able to work with one, a best friend that I grew up with,
Yeah.
lifelong friend, and two, be with someone that maybe thought the same way that I did, maybe was challenging the current status the way that I would. And so I just thought it was just timing. So again, that was a decision I made probably within 2 or 3 months at that time. Again, it wasn't like, hey, I'm coming back. It was probably because of those circumstances that I even decided to take a leap of faith.
Yeah. Yeah. Wow. It's so funny to hear you think about now being so you're chief investment officer of Witness Investments. Is that how you would describe that? Is that the right?
Yeah, I think the roles have changed, but one of the principles of witness
Okay.
investment, and
Okay.
my main role is with shaping the investment and capital strategy of what we're doing.
Okay. And I guess I'm just like hearing it, this path, this wandering path that you went on, it's almost like you couldn't have planned it any better, right? Like you got this like brand level structure, understanding at a very detailed level how to drive and influence performance for hotels, for a specific kind of hotels, which is conveniently the ones that your family owns. And then to when I hear you talking about the MBA and then the consulting work, like learning how to break down a strategy, find the risk in a business, present something back to somebody that like maybe you've got to talk them in, you've got to be persuasive and help them drive new action. All of that stuff like is like skill stacking in a way to lead you to this place where you are now. Yeah, so could you explain a little bit about as a principal at Witness Investments?
Yeah, and I would say witness has gone through an evolution in the last 5 years that I can get into, but
Yeah.
effectively, what we are is an investment and asset management company for hotels, right?
Mhm.
Primarily, the investments that we have are family assets or family investments through the main principles of the company. And so we haven't really been an active third party investment manager. I would say it's primarily in house, but we have a portfolio of 35 hotels in the Midwest. So Ohio, Indiana based. And to your earlier point, we're focused on select service, which is your basic 100-room hotel that won't have a restaurant, but has free breakfast. Brands like Hampton Inn, Residence Inn, Spring Hill Suites, Home 2 by Hilton. Those are the brands that we play in. And we're focused on secondary, tertiary markets. So suburbs of big cities or interstate properties in smaller towns off major highways. And so before 2020, we had a management arm as well. So we were the property manager, the day-to-day manager of the hotels. And in 2020, we decided to third party out the management. And so from that point onwards, we shifted to more of an asset manager. So we definitely were involved with the property managers that we hired because we are still the owners of the properties and the ultimate beneficiaries. And so we wanted to have a system and a team in place that ensured that performance maintained and quality standards were maintained.
Yeah.
But then we also started to evolve our investment vehicle. It started out that we wanted to, one, personally diversify after COVID because, again, we're heavily involved in hotels as a family.
Mhm. Mhm.
And COVID was a black swan event for a lot of industries, especially the hotel industry.
Yeah.
And it gave us the silver lining of COVID for us was, hey, you should probably diversify and think of other ways from a personal standpoint to look
Mm.
at investment and not
Mhm.
just pour every dollar back into hotels.
In
But we
like
still,
asset allocation, is that what you mean?
yeah, it's personal asset
Okay.
allocation just because
Mhm.
hotels are great and we really love
Mhm.
hotels, even post COVID, especially in the markets that we know.
Yeah.
So we still had this desire to grow Witness, but the funding vehicle was needing to change because personal allocation needed to shift a little bit lower for the family to be able to create allocation for other asset types, right? Whether it's
Yeah.
liquid or alternative investments. And
Yeah.
so that meant that we needed to create other ways to raise capital to be able to still do what we do and take advantage of opportunities in front of us. And so
Mhm.
we started off by doing deal by deal fundraising with friends and family, a
Mhm.
network of people that we knew and had asked before to invest with us. And so we got 2 or 3 deals done that way. And then late last year, we thought that we can be more efficient with this. And so we decided to create a fund. And we ended up setting a target of $15 million to go acquire at in the hotel
Mhm.
space. And we ended up closing that fund actually last month with 20 million in commitments.
Oh, wow,
And
That's
yeah, thank you.
awesome.
So
Okay.
definitely new for us because the
Yeah.
family was the one driving the investment
Mhm.
in dry powder. And we're still involved with it. Obviously, we're involved in
Mhm.
the fund, but we got a lot of investors that obviously were already in our family network and then added some new ones. And yeah, we're excited about the new horizon of Witness. So Witness will be that investment manager and investment allocator for hotels for our fund and still for the family capital that's chasing hotel deals.
Can you explain? Okay, so build creating a fund means that like you went out and asked people like, "Hey, would you want to invest in I guess we're going to be going out and buying this specific kind of like
Yep.
property and here's what you could expect as a return." Um
Right.
and I would assume like you have to be an accredited investor in this sort of thing. What kind of could you explain, walk me through a little bit or like anybody through what that high level, what that process looked like to raise a
Yeah,
fund?
sure. So you're exactly right. We started out with, hey, what's our thesis? Like, why are we raising
Mhm.
this fund? And
Yeah.
where we saw our opportunity and our credibility is in the things that we're already doing. So service, Hilton, Marriott, IHG, Hyatt, acquisition in the Midwest is our focus. And so we're
Mhm.
mimicking our portfolio in terms of what we're trying to acquire.
Ok
We did set higher thresholds for revenue density for each hotel. So we wanted hotels with higher revenue per hotel because they're just easier to manage when you have more revenue density in this environment. We can talk about it a little bit more, but we basically
okay.
set an investment thesis, right? And then to your point, we just said, hey, here are the returns we can expect based on underwriting today, seeing interest rates and our thesis of buy at a certain cap rate, which is the capitalization rate is just the net income that you're expecting from an asset divided by the purchase price. And so we wanted to get to these metrics, right? To your point of what our return
Mhm.
expectations are.
Mhm.
And we crafted a story, right? A fund is a legal document, but there's a storyboard behind it in terms
Mhm.
of what are you trying to do, right? Why should
Yeah.
you entrust us with your investment to be able to create this value? In
Mhm.
our fund, you can structure funds differently, but our fund was meant to be accredited investors only,
Yeah.
which the rules keep changing, but I believe it's some level of income or some level of net worth that
Mhm.
you have to qualify
Yeah.
for
Yep.
to protect both the investor and the fund.
Yep.
And so we raised it with, and we had a set target of under 100 investors. So we
Okay.
wanted to make sure that there wasn't a lot of small checks just to make it more
Yeah.
efficient for us.
Yeah.
But the value of it is that now we have this commitment that we can go purchase 4 or 5 hotels on our own without having to go through the logistics each time for paperwork and legal
Mm.
drafting
Mhm.
to acquire.
Got it. Yep. Okay.
And we chose
Mhm.
acquisition for a purpose because acquisitions have inherently lower risk than new development. New
Mm.
development, you can have timeline slides on
Got
the
it.
project,
Right.
budget.
Yep.
So we wanted to start with
Yep.
something that we know we can
Yep.
mitigate risk factors.
Yeah.
So yeah.
Could you explain okay, one thing you said is, "Oh, we can talk about that again." Oh, revenue density. So what is that? Yeah, what does that mean? How do
Yeah.
you measure that?
Yeah. There's an industry term called RevPAR, which is revenue per available room. And basically, we wanted to make sure that the assets that we're buying, because we have a management company that would come in to manage that, and we would want to make sure that there's inherent value of our platform.
Mm.
The more revenue you have for the hotel, so let's say it's a $5 million hotel
Yeah.
in revenue versus a $2 million hotel revenue,
Mhm.
there are some basic things that both require in terms of like management and
Mhm.
oversight. And so it's way more efficient to be working with a $5 million revenue box than $2 million revenue box in our model,
Mhm.
right?
Yep.
If you were on,
Right.
if you were on property and you were running the show, then you can do a $2 million hotel and be fine. But
Got it.
because we're
Okay.
trying to scale this
Mhm.
and we're going to have management
Mhm.
company, we're going to have
Mhm.
other partners, it really makes sense to stick to those guidelines for our
Yep.
thesis as well.
Okay. And if you're always in this kind of 100-room space of a hotel, then revenue density is likely, so it's two things, like higher occupancy and higher, like what's the rate that we can get
Yeah.
for this property,
Right.
like in terms of who's staying there.
Exactly.
So
Yeah.
that kind of
So we're,
limits where you're looking, and we're not looking at 60-room properties, or we're not looking at the places where demand is like fluctuates quite a bit. We expect a like steady flow of occupancy and a good rate that we can get there.
exactly. Yeah. It's just another threshold for us, right? In
Yeah.
addition to the brand,
Yep.
which market it's in,
Mhm.
the age, it's
Yeah.
just another threshold that we want to keep
Okay.
in there for our
Yeah.
thesis.
Are there some with low revenue density, like that do fit the other criteria for you? Secondary, tertiary markets in the Midwest within the like the Hampton Inn and the Home 2 and the Fairfield Inn residence. Is that what you said? Those are like kind of the four you stick around?
Yeah, yeah, there are a ton, right? There
Mhm.
also, if you go further along the chain, there are a lot of other properties like Comfort Inn and Best Western that have great return possibility in terms of percentage return and equity multiple. But again, it's just a different operating model and a different way to create the value. And we're not set up best for that kind of thesis. And so again, there's a lot of opportunity,
Yeah.
but yeah, we're sticking to that niche. Yeah.
Uh-huh. Got it. Got it. And okay, so you raise 20 million and you think, okay, I can go out and get 4 to 5 hotels here. So that means that you're putting 4 to 5 into each one of those. So what does that look like then? I would assume it costs more to buy the hotel than that much. So that mean that you're also getting some sort of financing as well?
Yeah, yeah. So our model predicates that we are putting about 30% down in equity,
Okay.
30 to 35%, $4 to $5 million per deal, and then leveraging up the rest with
Okay.
debt.
Okay.
Obviously, it's a tough debt environment right now with
Uh,
lenders tightening up, and
yeah.
we've obviously heard the news of several banks going under, and then other banks getting more pressure with deposits. So
True.
it's definitely a tougher environment. But yeah,
Mhm.
our
Mhm.
model predicates leverage for
Got
sure.
it. And so in that scenario, the like purchase price for these hotels would be what, around
15 million
15?
per asset.
Okay.
And then
Okay.
we're usually putting $4 to $5 million of the fund's equity into each one to acquire them.
Okay. Got it. Okay. And so when you're buying let's just, instead of thinking about 4 or 5, let's just think about one. If you're buying this, putting 30% down, how are you making money back in the fund? Is it that you're improving performance for the property?
Yeah, I think it's two ways. So obviously our thesis is not to buy just cash flow as is.
Right.
There's some
Mhm.
improvement lever that we're focused on.
Mhm.
So that could be a property that needs a renovation to be able to lift the revenues, because today the quality of the asset is not what it needs to be able to get market share that
Yeah.
what we expect the hotel to get.
Yep.
Another one could be it's a new property that someone hasn't stabilized. And so we want to take it over and stabilize revenue because they haven't reached its potential. Another one could be that, hey, it's stable revenue, but the efficiency is terrible because the
Mm.
management that's in there right now is not working, right? So
Mhm.
it could be a
Mhm.
play where revenue is stable, but we need to work on the
Mhm.
expenses to help improve the profitability.
Yeah.
So there's some improvement story. It could be a combination of things too.
Yeah.
We run into that where there's a renovation plus a revenue story plus an expense story. So it could be all
Mhm.
three.
Mhm.
And so how we make money is twofold. One is through the operation. So while we run the hotel, there'll be some cash flow that's generated after debt, and that is distributed out to the owners on a quarterly schedule, more or less, is how we function that. And then there's also some value increase when we sell, because
Mhm.
if we buy it and we buy it at a certain situation and we improve the performance, we do the renovation, we stabilize it, there's hopefully higher value for that to another buyer, right? At the end
Yeah.
of our hold.
Mhm.
And so there's going to be some cash flow during the hold of it, and there's going to be some value appreciation.
Right.
So if you think of it like a stock that pays you dividends, right?
Yeah.
2 or 3%, and then you sell the stock at a later date, but the stock is now worth twice as much as what you bought it for. You also get the value
Mhm.
pop from the stock
Yeah.
sale.
Yep.
It's similar to that kind of model, but you would
Mhm.
expect healthier dividends than the stock would give.
So let's say that you do see a hotel that needs a renovation. How are you calculating, okay, this hotel has this much potential, like in terms of it's worth putting $2 million into it to renovate the property because we think we could get this in terms of rate afterward, like this much lift in what people would be willing to pay to stay here?
Yeah, this is where my revenue management training from Hilton comes into heavy hands. So we
Yeah.
do a lot of we focus a lot on getting reports and analysis on the markets.
Mm.
So apart from getting the data on the property from the seller, right? Just
Yeah.
what it's doing in the market. We do
Yep.
our own independent analysis of hotels we think that it actually
Mhm.
competes with if we don't believe
Okay.
the data we got is correct or
Got it.
representative.
Got it.
And so we triangulate to what we think based on the brand, based on the
Mhm.
location, based on the asset, what we think the potential could be based on the market data. So we're always comparing relative what we think the market is and what we
Mhm.
can get as a premium to that. And this is why our thesis is so focused on the Midwest because we know these markets better. And
Yeah.
so it's easier for us to be more comfortable managing the analysis of the market than it would be in like a California or an Arizona. While we could do that, it just takes
Mhm.
more time and effort,
Mhm.
and you don't have that with an acquisition because the seller is trying to sell, and so
Sure.
you have to be able to move a little bit quicker.
Yep.
And we found a lot of success in trying to find acquisitions within a good driving distance of hotels we already have because we just know the
Right.
area better,
Right. Yeah, and I would
and
also
even the
assume, like, you by picking these ones that if you're, like, in secondary and tertiary markets, like, you've got a fairly consistent understanding of the type of customer that you could be getting to stay at this property versus if you're in a very dynamic market there's lots of different types of customers coming in depending on what day it is or what time of year it is that there's so much fluctuation that it's
yeah.
probably harder to predict. There's more volatility there, I would guess.
There is, yeah. And one layer is what we think we can do in terms of the performance. The other
Yeah.
layer is what is the composition of that performance? Because we don't want to be in a market where it's predicated on one account or one demand driver.
Yeah.
Because
Yeah.
if that demand driver goes away, then you're
Right.
stuck with this
Yeah.
free fall of value. And
Mhm.
so we like markets that have a combination of amateur sports teams,
Mhm.
manufacturing,
Mhm.
corporate clientele,
Mhm.
weddings. We like balance.
Yeah.
And even in our underwriting, we don't like many deals that are like, let's go ahead and buy this thing, renovate it, and sell it for a big number.
Yep.
Because then all your risk is based on how you exit this and who's going to buy it.
Mhm.
We like to balance return with cash flow during
Yep.
operations and
Yep.
some sort of appreciation. So we're not trying to hit a home
Mhm.
run on our
Mhm.
appreciation. I think those deals are different from the
Yep.
fun deals. Those are
Yep.
ones that you're buying at a severe discount, taking the risk of renovating it and then flipping it like a house flip would be.
Mm.
These are more you're fine tuning the operational
Yeah.
cash flow, but then you also get
Yeah.
some appreciation on the
I think that's like such a fascinating part of all of this is like what you said, fine tuning the cash flow. It's when you have 100 rooms and 365 days, right? There's so much opportunity to find room for incremental revenue. There's just it's not okay, I bought an apartment complex that now we've have a set rate for a full year out. Like you've got every day you've got a new chance to like continue to refine this and there's a lot I think there's a significant amount of upside there because of that.
Yeah, no, it's hard to look
Mhm.
at it this way, but that room is perishable every day. Even though it's
Yeah.
there the next
Yeah.
day, you lost the opportunity to sell it the night before
Right. Right.
or sell it at a too low of a price. And that's
Mhm.
what we're focused on today is that we want to try to, in some markets, we're trying to limit occupancy because you want to be able to push the rate more because that helps with
Mhm.
profitability
Mhm.
and it reduces wear and tear on the hotel because obviously more use, more wear and tear. And so
Yeah.
it's a
Yeah.
fine balance between getting the heads in beds and making sure it's the right heads in the
Mhm.
right beds.
Yep.
Yeah.
Yep. So what's the rev par you were saying earlier of revenue density, which is that blend, like you're saying, you could probably get higher rate and a little lower occupancy, and you would be okay with that. Is there another metric that you're like looking at regularly that like brings profitability into the equation?
Yeah, it's a good question. We've been trying to figure out a math equation that we can create ourselves to create like a RevPAR factor to profitability or a
Mm.
correlation, because
Mhm.
we do think that there's some more analysis that could be done. But honestly, what we triangulate to right now is that obviously we use occupancy, ADR, and RevPAR as our main metrics and the indices. So the performance relative to our competitive set. And we use ranks because
Mhm.
ranks gives us kind of an idea of where we stack against our
Yeah.
competitors. It's a fine balance where you want to try to get the most optimal RevPAR, but you
Right.
don't want to try to get it through just occupancy. Because if you do it through just occupancy, you will see the impact on the profitability.
Right.
If a hotel is running one in its competitive set in occupancy, but it's running
Mhm.
four in RevPAR, there is still
Mhm.
a possibility that they could be running one in RevPAR because it's just getting
Yeah.
that much high occupancy, right?
Mhm.
Whereas you could also run two or three in occupancy and one in ADR and still run maybe two or one in RevPAR. But your
Yeah.
profitability difference will be drastic because
Mhm.
that second scenario that I talked about will produce way more cash flow to the bottom line
Yeah.
than the first scenario because now you're renting more rooms, there's more housekeeping, there's more
Mm.
breakfast, there's
Mhm.
more wear and tear on the hotel, more maintenance.
Yeah.
There's the variable costs are obviously higher, right? And you're probably doing that at a lower rate because you're trying to get more demand to come to your hotel. The
Mhm.
demand in the market is the demand in the market. You don't create
Mhm.
demand, right? Well, necessarily
Yeah.
it's the demand. So you just
Mhm.
how you're capturing it.
Mhm.
And so basically if you want to try to get more share, you're probably going to have to give up rate in most cases to get it. And
Yeah.
so you're filling that last room with less profitable business.
Yeah.
Not always, but I'm generalizing. I don't want the revenue management people to say that I'm off. I'm generalizing, but I think
Yeah.
that it's market by market specific. Everyone has to do their
Mhm.
own analysis, but I think that in some cases you may be hurting yourself by how you get to the RevPAR if
Mhm.
it's overly weighted on occupancy.
Yeah. No, I think that's a great insight. I love that. Yeah, and I would say I would like to do some more of these conversations with you because I have so many more questions, but I'd love to dig in more about your family and your family business, and I'd love to better understand that side of this, which, I don't think maybe we don't try to dig into that today because this is, I think, a
Oh,
good place to start. Okay, but could I ask maybe one more? So earlier you said that like there are other models, right? Like you have picked the model of like within this focused service, 100 rooms, free breakfast, no restaurant. Um so if you went like what's the game that's being played then like in the economy space? And then I'd love to know even like on the next kind of the next band of okay, maybe you do have a restaurant. Like what do those kind of lanes look like above and below, where you play?
yeah. So I think the economy segment, a lot of it is predicated on having hands-on ownership and hands-on operations. I think there is a possibility where you could buy properties in bulk and then sell them off to owner operators. And so there's an opportunity to make
Mhm.
return on a flip. But
Got it.
in terms of like
Mhm.
if you're actually going to
Mhm.
hold and operate, those are definitely predicated more towards people that are going to be more hands-on because your profitability and your margin is the most important thing, right?
Yeah.
Because your RevPAR bands are tight. It's not like you have massive opportunity to take rate because of the segment that you're playing in and the expectation of the consumer. So you really
Yeah.
need to be able to control spend and expense and how my parents started out, to be honest, right? At the end of the
Mm.
day.
Mhm.
And so you can run those properties with less staff and be more hands-on. So I think that's what I would say is probably the name of the game in that space. Apart
Margin
from
that the margin that you have is you're probably not gonna staff that very much, so you're going to need to be like, heavily involved, like, in the day-to-day operations if you're gonna own, like, a property like that to be able to make a profit, it sounds like.
Is spent there. So adding another
Right.
property, adding it to, it
Mhm.
just becomes harder to
Mhm.
balance both unless you have a lot of partners or a lot of different people
Right.
helping you.
Right.
So your trade-off is, I think, scale to a certain degree, right?
Yeah.
Unless
Yeah.
you enhance that team. So I think
Okay.
that's why it's easy to start that way, because you're
Yeah.
maintaining, you're managing risk by being there all the
Mm.
time. And
Mhm.
so
Yeah.
you have a little bit more control on expense, which allows you to play better if revenues drop or revenues increase.
Mhm.
Like, you just have a better grasp. Whereas if you're in my model or our model, which is the traditional select service model, if revenues drop, it's harder to control the bleed to a certain degree. There is a point that you can, but it's just a little bit harder than if you were obviously on property and you were the
Mm.
general
Mhm.
manager,
Right.
you're part of the front desk.
Right.
It's easier to flex the expenses.
Yeah, 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 yeah. And then what about like why do you stay away from like why do you focus on like without restaurants and in the branded space?
Yeah, I think part of it has to do with our markets. Like,
Okay,
those products don't make sense in secondary, tertiary
got
markets
it.
for a lot of
Mhm.
times. And I see an revolving customer segment, right? Like, I don't think people want to eat at most hotels. And I'm generalizing, but
No,
I
yeah, I
think
get
that
that.
people want to go
Uh-huh.
to a trendy restaurant.
Sure.
And so if we were
Mhm.
to get in that space, we would like something that is more like a boutique with a restaurant operator that's really
Mhm.
good at what they do, and they bring a unique concept that even people from outside the hotel would want to come into, right?
Right.
And energize the space.
Mhm.
Like a Hoxton hotel in Chicago, where
Mhm.
people come for the food. The hotel
Yep.
is it's
Yep.
there, but they come for the different restaurants.
Mhm.
We don't mind smaller operations like a Hilton Garden Inn, where you have a small restaurant where you can close it for during the day, but it's really breakfast and light dinner service. Like, you're
Yeah.
running like a select service, but you're still
Mhm.
semi
Mhm.
full service. But for us, we just, again, our history is in this select service space. And so we
Yeah.
feel like
Yeah.
between our markets and the operating model, that's
Mhm.
a better space to play in. But if we were to shift to having a restaurant or something, it needs to have some sort of wow factor, I think. A famous restaurant group or
Yeah.
a bar that's pretty cool that people want to come into, because then you start
Right.
to bring real value to that amenity as opposed to just having it to have it because
Mhm.
it's a requirement.
Yeah, and I think that there's a lot of wisdom in what you're saying of this is our market. This is we want to play in the place like the space that we know and we're going to do our best to optimize that versus you could get distracted or divert spend a lot more time trying to figure out a lot of other kind of ways, but you're saying let's like do this really well. And then also
Yeah.
like when it comes to our investments, let's find and pursue other things that maybe help mitigate the risk that like from what just having all of our stuff in hotels in general. We'll diversify
Yeah.
in other ways instead of trying to
Right.
just diversify in terms of like brand and chain scale and market type.
Yeah, we've gotten hotels that are full service on our desk for a really low basis. And
Mhm.
I think they can make a lot of sense from an investment standpoint. But when we layer on our operating model and our thesis, like it just, we need to create boundaries for ourselves,
Yeah.
because you can get, I wouldn't say out of control, but you can lose your way to a certain degree. And
Yeah.
that's why I think the fund was really great for us to continue to focus in on what we know and what we know.
Mhm.
And honestly, that's where we think the opportunity is too. So
Yeah.
we're really excited about it. And we think that the Midwest, it's silver line of COVID. The Midwest has been a really big winner when it comes to
Yeah.
reshoring and manufacturing and logistics. And we're really appreciative of the opportunities that we have in our own backyard.
Yeah. I love that. All right. Thanks, man. This has been really good. I really appreciate making the time, and I hope you'll join me again soon.
Yeah, of course, man. It's
Yeah,
always good to chat with you. And yeah, we'll definitely dig into the family stuff. I think it's a whole other conversation
totally.
that's, I think, looked over a lot of the times,
Hmm.
or the personal side. And I'd love to shed some light on it. And hopefully it helps some of the folks listening in.
Awesome. Thank you, Sagar.